Good morning, and thank you for joining the PegNet status meeting. And we're going to go over kind of what we've done this week and what we're working on and what the state of everything is. I will say that this week we didn't make too much progress on the PegNet specific code, largely because I've been working an issue in Accumulate with Tendermint that has caused a bit of stall of um, the more significant transactions in Accumulate. And it is a bug in Tendermint. We've figured out exactly how we triggered the issue. And right now, the Tendermint is working through a bunch of backlogged messages to bring the network up. And that may work, or the Tendermint may not be able to catch up, in which case we have to perform some surgery. And there are a couple of surgeries we can to get the network up and prevent it from ever getting into this state again. Using PegNet has greatly accelerated development for Accumulate, but it also comes with a slight disadvantage that we're not experts in the PegNet like we are in the code that is Accumulate. Another interesting um, aspect of the way, uh, let me see, sorry. Um, One interesting aspect of the way we implemented Accumulate on Tendermint is Accumulate has its own state, its own databases, and that's what's really important. What we're getting from Accumulate, from Tendermint, is the consensus code and the consensus model, and we don't actually need its state to create all the cryptographic proofs that Accumulate built. So we have some options here to fix the system that you normally wouldn't have. Anyway, that has just buried us. Um, So let me take some opportunity to talk about a few things in the PegNet that we say all the time, but we don't really define. So a lot of times you'll hear us talk about the oracles that the PegNet uses, and you hear us talk about the proof of work that we use when mining, and you will hear us talk about proof of stake um, and validators. All of these terms exist in the broader crypto space, and you can kind of look at what other people say about them. But let's just be clear right here what we're talking about. So oracles are used in every blockchain to bring information from outside the blockchain into the blockchain where it can be operated against. So, for example, if I wanted to create a long and short trading system on Ethereum, I would need an oracle that gave me prices for those securities or commodities that a person might want to take a short position or a long position against. And then that smart contract would, when the price got too high and I was short and there wasn't enough collateral, then they could demand more collateral from the person holding the short position, or that short could get liquidated. Vice versa, the long. If the price got too low and there wasn't enough collateral, then the smart contract could demand more collateral, or the long position could be liquidated. The liquidation of a long and short always requires a market price, and the market price is always going to be outside of the blockchain. So a oracle is needed to bring that price into the blockchain. Now, for the PegNet, we use oracles because we need the prices of all the assets so that we know how to value a conversion of one asset into another. So let's go to the second definition. What is a conversion? So the PegNet works as a self collateralizing protocol where all the tokens that are within the PegNet basically collateralize the value of every other token in the network. It's a novel way of creating a pool of assets. And that means that if you have USD inside the PegNet and you would rather be holding euros, then I need to know what the value of the USD is relative to the euros. Now, in the PegNet, we pick an asset to serve as the base, and we picked USD. We could have picked anything, but that's what we picked. So I need to know how many euros I get for one USD in a conversion. And the PegNet allows you to do that conversion of USD to euros. And the network as a whole, its total of USD goes down and the total of euros goes up. But at any other point, I can do the conversion the other way and convert from my euros back to USD. So those conversions, though, all require a market price, and that always requires an oracle. So then the question becomes, how do we have an oracle in the PegNet? Well, the way we do that is we create a mining role to validate the oracle data that the PegNet holds. And at some frequency, the miners look at the oracle data and they validate it. If they validate it, they start mining it. And when that mining of that oracle data reaches a certain level of difficulty, then that difficulty is logged as securing that mining record. So miners basically sign with doing this proof of work against the oracle data. Now, proof of work is a process where you do a random search for a solution. And generally speaking, in proof of work, you look for the most zeros in your hash. And we use a function that is only effective on CPU mining. So the proof of work function says this solution that the miner's looking at is worth so much. And if that's not high enough to do anything, another solution is generated, and another one, and another one, and another one, until the miner finds a solution that's good enough for the network, and then it submits it. And when you submit that solution and yours is the best solution, you earn a reward. Um, so proof of work ends up validating the price list in the PegNet. Now, the price list itself is generated by validators. So the validators in the PegNet serve as the parties that run this, effectively a big smart contract over the PegNet. That smart contract to handle the conversions and to collect the data from the real world, provide the oracle function of the price data. That functionality is very complex and big, and not easily implemented in smart contracts like on Ethereum or whatnot. The gas fees would be too high, and the smart contracts would not have access to the real world, so you would have the oracle problem anyway. How do I bring data from the outside world into the PegNet? So we have a set of validators, and those validators pull that data. They run a fixed, cryptographically provable set of code. Other parties can run that code and validate what the validators are doing, and the miners can access the real world and validate the prices that the validators provide. And this whole function ends up working with lots of checks and balances, all to make sure that the PegNet runs well. Now, if the validators have responsibility, they need to be paid, but they need to be paid in a way that makes them responsible for acting well. And so we're going to use proof of stake. Those validators will hold some assets, and those assets will be big enough that if they misbehave, if the miners determine that they're misbehaving, or a third party auditing the PegNet determines that they've been misbehaving, they can be reported. And once that report is validated by all the parties involved, then their stake, the tokens that are effectively sitting in escrow that justify them uh, playing the part as a validator, you could think of them as bonded by uh, their stake. That stake gets slashed and they lose money. Therefore, it's in their interest to behave well because they don't want to lose money, but they also want to gain the rewards of participating. So I hope I've done a reasonable job of going over what it means to be an oracle, what it means to be a miner, what it means to mine, what it means to stake, what it means to be slashed. Now, I've also been asked to summarize what is the point of the PegNet. And the PegNet uh, is a mechanism to create a set of stable assets that are fairly large, like could amount to 50 or 60 different assets in the world, could be even more than that. And all of the tokens that are in these assets self collateralize the whole protocol. So all of their values, respective values, support the value of all the other assets within the PegNet. And one of the problems with stablecoins is that you have to have some mechanism to make all of that support the value of all these assets. And the way that most of that is done in the real world is the most common thing is to just take a bunch of USD and put it in a bank or in treasuries or something, and those back the asset. But that means you have to have a whole bunch of something like USD and a whole bunch of something like the euro, and they can't network together to support both values. They have to sit there on top of their own assets. And if one of these loses their peg, like USDC did recently with a bank failure, and the bank was shut down and people got worried whether they'd be able to convert their USDC to dollars, then it can lose its peg. And then when the banking situation was resolved, then the USDC went back to its dollar value. That's the problem with stable assets. And those are also centralized by definition because somebody has to own the bank account behind it. And that means they're also regulated. So they're regulated as third parties. So governments can easily make laws and regulations that limit the usefulness of stablecoins for their stated purpose, which is just as a stand-in for dollars in crypto exchanges or in transactions where the regular banking and financial system doesn't support those transactions. So a lot of South American countries and a lot of African countries have increasingly used stablecoins as a means of transacting because they can do so without having to go through the Western banking and financial system, which is largely slanted against them. So that's the kind of mixed up why you want stable coins with how the typical stable coins are created. Uh, but in the case of collateralized stablecoins, it's almost like an end round, but within the banking financial system. Another type of stablecoin is an algorithmic coin, and the algorithmic coin will not hold any USD in a bank account, and an algorithmic stablecoin can be implemented in a way that's distributed and autonomous, so it's not centralized. And to date, algorithmic coins were the um, only alternative to uh, asset-backed stablecoins. Now, the first algorithmic coin that might come to mind is the DAO and the uh, Maker coin, Maker DAO. What's that?
Yeah, I was
Yeah,
just
Maker DAO. And
dying.
and the die coin, is it die? I'm suddenly have a mental issue. So the die is a dollar, and it's backed by collateral, and there's interest involved in this algorithmic, and it's a bit complicated, and I'm not here to explain that particular algorithmic coin. There was also Terra Luna, and that one actually failed through an attack. It was also an algorithmic stable coin. I guess there is that third type of coin, which is a collateralized, but collateralized with some other asset like crypto type coin, and that can be distributed because you could have a lot of Bitcoin and a lot of Ether that backs a USD coin, but it needs to be over collateralized because crypto is much more volatile than the dollar. And if the value of the crypto behind the dollar ever gets too low, then that makes that stable coin lose its peg because people will lose faith that it's fully backed. Now, there's probably a little bit of leeway um, there, but it's still a pretty obvious flaw in that type of coin where the crypto market can lose 90% of its value and then go up by 500% its value. And so the keeping the collateralization of a stable coin, somewhat balanced is very hard. We're a fourth type of stable coin, and that is a stable coin that creates incentives to self collateralize. So to make it a shorter explanation, the PegNet is created to use a basket of stablecoins that self collateralize and uses incentives and market incentives to create that stabilization. And that stabilization is mostly created through arbitrage, staking, and mining. And that's what we want to do. We don't want to deliver one asset, but we want to deliver many assets and allow the user to choose which one easily within the protocol in order to make payments, in order to manage their holdings within their treasury, and in order to, in some sense, an easy way of speculating between the assets within a protocol that does not involve ever requiring third parties to enable those transactions. So no third party is required to make a transaction uh, in PegNet assets. No third party is required to do a conversion. No third party is involved in trading of these assets inside of other exchanges outside of the PegNet. So it's purely market driven. Might be a little wordy. We can work on the wording and get it a little shorter. But that's about all I have for today.
No, thank you,
What's
Paul.
that?
Thank you, Paul. Good, very good.
Thank you for the questions. All right. Well, thank you guys for joining the status meeting, and I appreciate everybody's support. And we'll talk to you next week.